Good afternoon, everyone. My name's Neil Stockham, and I'm the lead partner for the retail sector here at BDO. And on this glorious spring day, can I extend a warm welcome to you to our webinar today. As we know, the last 12 months have had a huge impact on people and businesses throughout the world. And as far as retail is concerned, this has triggered an explosion in online activity, knock-on effects on stores and other channels, while shocking supply chains into a rapid and significant adaptation. Thankfully, the rollout of vaccines should spark a return, hopefully, to the more stable, freer life we enjoyed before the crisis. But I think many things have now changed irreversibly. Consumer businesses in general have stepped up well to meet these challenges, flexing online offerings and other channels and overcoming those supply chain obstacles. But as we know, evolving business models to meet these tests requires investment and a focus on the bottom line. So in an environment already complicated by uncertainty, employing strategies to identify areas where resilience can be improved and free cash can be released continues to be key. So joining me today to provide some colour on these areas are Katie Rabindran, who's a director in our innovation and technology team. And she's going to share her thoughts on how retailers can maximise R&D tax relief. I've got Cheryl Thompson, one of our employment tax specialists, who's going to provide some updates on the government support packages and discuss how retailers can access value through apprenticeships and manage those key employment tax costs. And Martine Pearson, who's going to share her thoughts on how to optimise cash flow through VAT. If all runs as planned, we should have time for a few questions at the end of the presentations. So feel free to post these through the Q&A function at the bottom of your screen, and we'll endeavour to answer as many of these as we can, and those we don't get to, we'll revert to you after the webinar. So thank you. Hope you enjoy the presentations, and I will hand over to Katie.
Thanks, Neil. So as Neil explained, I'm a director in our innovation and technology team. And I'm going to talk a little today about R&D tax relief and how it applies to the retail sector. So if we head to the next slide, and this slide sets out what I'm going to cover. But before we really get started, I thought we'd do a little exercise to make sure everyone's with us and ask you a quick poll question. So if you wouldn't mind answering the question that's just popped up on your screens, because it will help me in tailoring what comes next. So the question is, do you already make UK R&D tax relief claims? So I'll leave that there for a moment while I talk through this slide. And in this slot today, I'm going to focus on how R&D tax relief applies to the retail sector, the types of R&D claims that we see, and how what's important from the retail sector perspective is the model you choose and the decision in terms of who undertakes the innovation for you, whether it's internal or external. And I know that cash is really tight at the moment, so I'll comment on what the bottom line is and also finally provide an update for those who are already making claims. Great, thank you for sharing the poll results. So we can see a third of the people on this call are already making R&D tax relief claims. So that's fantastic news, because we do see that retail sometimes miss R&D tax relief as a way to bring cash in. And for those of you who've answered no, we've got some updates coming along in terms of what you might be looking out for in terms of the claims that you made. So if we pop on to the next slide. Here I'm sharing some examples of where we do see R&D tax relief claims across retail. And you'll see a next poll question pop up in front of you about whether you're investing in new technology somewhere across your business. And I guess here I'm aiming at those people who probably answered no to question one, but if you've already answered yes, please include something here. Because I think, as you'll see once the poll question leaves us, some of the examples on this slide, or a lot of these, focus around how technology is used in retail. And in preparing for the webinar, Neil just asked me to think of all of the ways where we see R&D claims across the spectre to help you explore within your business to see where it might apply. So that's quite interesting. The vast majority of you looking to invest in new technology somewhere across the business at 78%, and only 22% not looking to implement new technologies. That doesn't particularly surprise me given what we've seen across the retail sector. So as you'll see on this slide, these are probably some of those ways in which you're thinking you'll invest in new technology across your business, whether that is COVID related or simply as a way to keep it more cutting edge in terms of what you do. And I'll let you read this slide, but I wanted to share some examples for me that stand out in terms of where we see R&D in retail. And the other point I wanted to draw out in chatting to Neil and preparing for this was that in retail, we often see the bar set very high in terms of what you believe qualifies for R&D tax relief. So you'd be looking for something amazing or really transformative for the business in order to claim this relief. And actually, that's not where the bar's set by HMRC. We're simply looking for something that is a scientific or technological advancement. So it's better than what's gone before and resolve some kind of scientific or technological uncertainty. So some real life examples for you of claims that we've seen might be around things like innovative customer engagement. So we've got a cosmetics retailer, and obviously they've adapted to COVID, but even before that, we're looking at how do we market our products online? And they developed some new technologies, allow customers to see the impact that makeup would have on them without actually going into the store and trying those products on. And all of that technology behind that qualifies for R&D tax relief. So they got some cash back from that. But we also see it in new product development. So as an example, we've advised a children's shoe retailer on their innovative product development, including things like new materials that they include, or new shapes and sizes that they're looking, and styles that they're looking to put together. And that new product development is often a rich theme for us in terms of qualifying R&D activities. And finally, IT systems. So customer data continues to really drive additional sales potential across retail. And we've helped retailers look to, for example, in purchasing a new system and having to integrate it with existing data. So all of those pieces can include qualifying R&D activities. And I really hope this slide sets out for you the wide range of innovation that can qualify for R&D, and also demonstrates to you some of the areas in which we've helped our clients to identify that. So if we move on to the next slide, here all we wanted to set out is how beneficial is it to you? I know that time is tight and I know that cash is tight. So why would you choose now to explore UK R&D tax reliefs? Well, there are two schemes of R&D tax relief, one for small or medium enterprises. Effectively, that's for groups who have fewer than 500 employees, and one which is the research and development expenditure credit. So effectively, if you've got more than 500 employees, you'd certainly be in that scheme. And there are two different rates that apply. So if you're a small or medium enterprise and you're making losses, you can reclaim up to a third of your spend on qualifying R&D as cash. If you're a profitable business, then you'll see an additional 25% of cash based on that investment. Large companies, regardless of which situation you're in, will see around about 11% of your spend being funded in cash relief. So it can be really beneficial to you. And another point to mention on that large company scheme is that the credit is normally accounted for above the line. So it can be beneficial in two ways for businesses that are finding things tough at the moment. It can increase EBITDA and also increase cash flow. So some really good news if those things are key to your agenda at the moment. So if we flick to the next slide, what I wanted to do here is set out some of the key points as I see them for retailers. So most large retailers with those headcount thresholds mean that they will be classified as large companies and only able to claim that effective 11% cash refund. But many upcoming retailers will find that they qualify as an SME. And because of that key difference in terms of cash value, it's really important to start to look at where would we fall. So like we will obviously come on to where could the R&D be in the business, but what's it worth to you are those key factors. So if you can do a little bit of upfront reviewing of the business and whether you meet that 500 employee count threshold or not, you'll see which of those schemes is likely to apply to you. So the second part is, where do you find this R&D? And this is a really key challenge for retail, because unlike an R&D business, like a life sciences or an engineering business, where perhaps the R&D is specifically identified as research and development, in retail projects, it's almost certainly coded in terms of the commercial value that it brings to you. So that might be e-commerce, it might be logistics, it might be IT, it might be the new product development. So one of the things we found works in retail is adding a new question on in terms of any business partnering that you're doing about either the creation or use of new technologies across the business, which will help identify where those pockets of innovation lie. And also in your new product development, asking if new materials are used or new processes used in terms of production or the innovation and design and style of the items. So adding those questions onto your business partnering will start to widen your net in terms of where this R&D tax relief and R&D activities could occur, making it easier for you to identify within the business. A third point here is about outsourcing, and a key question for retailers who are classified as large is regarding business model, which I mentioned at the outset. So we typically see retailers either selecting that technology for them is going to be something that they outsource so they can focus on core business activities, or those that consider technology and new IP a really core part of what they do and a differentiator in how they do it. And so they invest in that in terms of their own business, whether that's in bringing people on as employees or ownership of their own IP, their own way to do these things. And under the small or medium enterprise rules, that distinction doesn't matter too much, because even work that is contracted out as R&D can be included in the claim of the company itself, so the retailer. But under the large company scheme, that differential can be critical. So in-house development work qualifies whatever. So if you have brought people on and they're doing work in your own in-house IT team, regardless of which scheme you qualify under, you can claim R&D tax relief. Whereas if you contract work out to third parties, the nature of the relationship between you is what's going to determine whether or not you can claim for that work under the R&D tax relief scheme, or indeed if it's your contractor that qualifies. Now, I think it's always worth a review of those contracts to see whether the claim is actually yours. But even if it isn't, being aware that your contractor can be funded by up to 11% of spend can be really useful in terms of the negotiations you might enter into. And finally, I wanted to mention a point on capitalisation. So often investment in technology will be capitalised as an intangible fixed asset and put onto the balance sheet. But for tax purposes, if those activities are effectively qualifying as R&D, and the point regarding third-party costs are less important, you can take an in-year tax deduction for that cost. So you've capitalised it and put it on your balance sheet, but for tax purposes, you've taken a deduction within your profits chargeable to tax, and in addition, potentially claimed that 11% cash. So that can bring two benefits for you: benefit in reduction in your overall corporation tax charge, as well as the UK R&D tax relief itself. Okay, so move on to the final slide now. So really this slide is here for those poor souls who were the third of you who are already making claims for R&D and already know how generous and important they can be. This slide is to give you some updates in terms of what's happened most recently in terms of R&D tax relief. So the first of these, which I think many of you will know intimately, unfortunately, is the coronavirus job retention scheme. So clearly you can't be doing R&D if you are not actually working. So you will see a reduction in current claims if you've made use of this in terms of the teams that you're claiming for, because you can't claim R&D tax relief on furlough payments or payment top-up payments that you've made. The second on these, which I think is really important, and it probably is important for whether you're claiming or you think you'd like to claim, is that there's currently a wide-reaching HM Treasury consultation on the meaning of R&D tax relief. So that covers the definition of R&D itself, it covers the rates of relief that I ran through, and it covers what qualifying expenditure you can make a claim for. And my take on this is that effectively with Brexit, the UK government has looked to try and make the UK a really good place to invest in terms of innovation. So it's an opportunity to set out for them how the scheme should be widened, whether the scheme should be more generous, and any other extensions that we think are relevant to business. And it would be really nice to have a strong retail response to that as well. Retail's really suffered with the recent shutdowns, and R&D, we're seeing a lot of R&D in terms of their response to that, but actually could more of that be supported by government, and how could it be done? So we'll be issuing a survey to clients and contacts over the coming weeks. And if you'd like to be part of that, hopefully everyone on this call will get a link to complete that. And if you've got more comments, I'd be really happy to have a conversation and hear your views on how supportive that scheme can be. And thirdly, I just wanted to touch on grants. I focused this presentation on R&D tax relief and how it can bring value and cash to the business, but clearly grants are another effective way to do that, and our R&D team covers both grants and incentives. Restart grants are this new, well, I'm sure you're all aware of the opportunity for non-essential retail to claim relevant restart grants, but if you need any support in the application for those, or indeed just learning a little bit more about them, please do get in touch. And in fact, there's an article available on BDO's website right now, which contains some high-level information about how you would do that. So we can help you in supporting on any of these schemes in terms of calculating payments, calculating what could be in terms of cash for your business. And I hope that by combining some of these grants alongside R&D tax relief, we can help you to gain some more cash. So Neil, I think I'm passing back to you. Oh, straight on to Martine. Sorry, Martine.
Thanks, Katie. So in the next 10 minutes, I'm going to talk you through some of the ways in which indirect taxes can help to optimise cash flow. In a retail environment where gross pricing is often at play, minimising VAT on sales and maximising VAT recovery can make a real difference. It's been a really busy 12 months for the retail sector with COVID and then having to deal with Brexit, with a real focus on keeping the business going. Well, hopefully life has calmed down a little bit and the world has started to settle. So now is a good time to take that step back and to review day-to-day processes and to consider whether there's anything that you can do to enhance your cash flow in the business. Next slide, please. So first I'm going to cover P&L savings, and then I'm going to move on to working capital. A lot of these ideas on this slide are not new, and they've been around for a while now. It's therefore a useful reminder of the things that we can all do within our businesses to make a real difference to the bottom line. With regard to VAT liability, what I often talk to retailers about is stepping back and considering whether you've applied the correct VAT liability to the supplies that you make. As I say, something quite simple, but actually in some circumstances, it can make a big difference, especially where you've got a gross pricing model in place. So can you do anything differently? Can you apply a different VAT rate? If you're selling a bundle of items together, for example, and you're selling it for a single price, have you considered whether you're selling a single item for VAT purposes or whether you're selling an item made up of multiple goods or services for VAT purposes? Again, looking back at what you're selling and whether it's a single or mixed item that could have different VAT rates or a singular VAT rate can make a difference if you're selling a bundle of items. And we often see this in the grocery retail sector, where you might see things like meal deals, for example, with sandwiches and drinks and crisps, for example, all bundled together for a single price. Again, that concept can apply across the retail sector, depending upon the type of products that you sell. And as I say, if you're selling it for a single price point, and you're able to look at shifting some of it to a zero rated position, then that can make a difference actually to the amount of cash you get to keep at the end of the day. As with liability, there's often other things that you can think about, and these are kind of around the non-core sale transactions. So have you received any money within the business that might not actually be a supply for VAT purposes? For example, are you collecting donations? Have you received a government grant? Or have you received any compensation, for example, for payment or loss? Again, looking at the non-core transactions and the VAT liability of those can make a difference at the end of the day if that does not need to be accounted for. With regard to retailers, we often talk about daily gross takings, and we often talk about retail schemes that are in place. And with larger retailers, they often have to have a retail scheme agreement in place with HMRC, which is basically a document that sets out all of the adjustments that they will make to their daily gross takings figures. So some of my work over the last 15 years have been really looking at the DGT figure and ensuring that retailers are adjusting appropriately for things like discounts, free items. Are you adjusting correctly for returns? What about fraudulent transactions? Even things where at the end of the day, the till may be short. You may get till shorts or overs in respect of the cash actually taken versus the sales value. There are adjustments that you can make in respect of your daily gross takings figures and the VAT that's ultimately payable. So definitely stepping back and looking, even if you do have a retail scheme agreement in place with HMRC, to make sure all of those type of adjustments that you're allowed to make to your gross sales figures have been applied correctly. One thing that we talk to retailers quite a lot about in the recent months and actually over the last 12 to 18 months is the VAT treatment of gift vouchers. So we've seen a change with regard to the gift voucher rules, not just in the UK, but across the EU. And really looking at when VAT is accounted for and looking at whether you're selling a single purpose voucher where VAT should be accounted for on issue versus a multi-purpose voucher position where VAT is due on redemption. So again, looking at your business, are you selling everything at the same VAT rate? Are you selling multiple VAT rates? Because you can then switch from a single to multi-purpose voucher position. And if those vouchers are never redeemed on multi-purpose, then in theory, there's some breakage in the business and some cash where VAT does not need to legally be paid over. Finally, on this slide, I can't move on without touching on Brexit. So lots of discussions with retailers at the moment regarding customs duty. When we talk about P&L savings, we're talking about absolute costs. So customs duty is something that needs to be reviewed by all retailers if you are incurring customs duty. So not just the customs duty, but also import VAT. So are you claiming the correct amount of import VAT? Have you applied for postponed import VAT accounting that enables you not to have to pay over and claim back the import VAT at all? Really important if you've not looked at that to look at that going forward. With regard to customs duty, it's an absolute cost. So I'd always recommend businesses look at whether they're applying the correct commodity code, whether there are any simplifications that can be used if you're moving goods in and out of the UK. More important now, obviously, in respect of the UK leaving the European Union and goods flow from Europe into the UK, especially for processing. There's lots of reliefs that can be looked at around inward and outward processing relief, which may help to avoid a double charge to customs duty. So yes, lots and lots to think about on the P&L side. So I would encourage you all to step back, look at this slide and consider whether you have applied all of the arrangements that are possible to help bring cash back into the business. Next slide, please. So on this slide, we're really talking about working capital. So making sure that you're paying VAT as late as you can and claiming VAT as efficiently as possible. There's lots on here around input tax recovery. So ensuring that you are claiming VAT on the costs that you incur, not just on the big things, but also in respect of things like petty cash and employee expenses. So you'll be surprised about the number of companies that we go speak to. They actually say that it actually takes quite a lot of time to look at the employee expenses position or the petty cash position. Obviously, while shops have remained quieter, we will see a reduction in employee expenses potentially, but it's definitely an area that would bring extra money back into the business by making sure that you've got a clear process in place that enables employees to claim and for you to claim the VAT back off the back of any of those costs. On a bigger side, it's often useful to look at, as I say, input tax recovery, but in the situation whereby you might not obtain the evidence at the right time. So a really good example of this is looking at whether, if you don't get the VAT invoice that enables you to reclaim the VAT at the appropriate time, maybe have a look at whether it's possible to claim VAT recovery by going to HMRC and getting approval for alternative evidence for input tax recovery. So a good example of this is that we worked with a retailer who had a number of stores, had contracts with lots of different landlords and multiple property portfolio. They weren't getting the tax invoices at the right time in order for them to recover the VAT on the rental charges that were coming into the business. The landlords often issued requests for payment. And obviously that's not a VAT invoice, so you can't recover the VAT back on the receipt of that document. But actually, due to the number of smaller landlords and the multiple number of stores, it's quite difficult for that retailer to actually keep phoning, keep chasing to obtain the evidence to allow it to recover the VAT. So they were just not recovering the VAT on some of those big property costs. We went into the business, had a chat about anything they're not reclaiming, and identified that they did get, as I said, a request for payment from the landlords. So we said, why don't we go to HMRC? Let's go to HMRC and request alternative evidence for VAT recovery, based upon the fact that we know the landlords have all opted, because we get the invoices in, we see that VAT's always been charged on the rents. We always get the request for payments, but we're chasing our tail quite a lot with regard to obtaining the correct and appropriate evidence for VAT recovery. And HMRC agreed a backdated 4-year claim for that business in respect of the VAT that hadn't been claimed, but also agreed that going forward, they could use the request for payment as their evidence for VAT recovery, provided that they put a process in place to ensure that they weren't claiming the VAT twice if they were to receive the VAT invoice. So it's really important if you do have any of those chunky costs coming in where you don't have the evidence, that you consider alternatives. We've also seen this in another example more recently, just before Brexit, where a business registered for VAT and they weren't obtaining the C79 certificates that allow you to recover VAT on import VAT. So they'd incurred a huge amount of import VAT where they didn't have the correct evidence for recovery. So again, went to HMRC, explained the situation, and HMRC agreed that they could use alternative evidence for VAT recovery by way of the C88 documents on imports, which enabled them to recover the VAT. Again, agreeing at the same time a process to be put in place to ensure that the import VAT wasn't being reclaimed twice. So lots to think about there. On the output tax side, a couple of things to mention before I close really on VAT and cash flow is things like payments on account. So payments on account are for larger traders who have breached the payments on account threshold in earlier periods. What often happens is that they have to make payments on a monthly basis and a balancing payment when the VAT return is submitted. Obviously, this year has been a year like no other, and trade has been down. So in some circumstances, the payments on account regime has been automatically withdrawn for some of our clients where the turnover has dipped. But actually, in other occasions where the payments on account have been based upon prior trading annual periods, it's been possible to go back to HMRC and agree either actual payments on account or reduced payments on account to reflect the actual trading business. Because what we found is that people are paying, obviously because the payments are set 12 months in advance, we're seeing huge amounts of VAT being paid over and then a massive reclaim when the VAT return goes in. So just trying to realign today's business in respect of the way the retail world looks to the current circumstances, and looking to agree ways with HMRC to enable a clearer and better reflection of trading patterns. As I said before, PVA is a really important thing with regard to imports, making sure that you tick the box on the customs declarations so that you don't have to pay the import VAT when the goods come into the country, but are able to plant on the VAT return is really important, and it's a clear way in which you can stop paying over money to HMRC and clearing up some of that cash to spend it on more important areas of the business. And then my last closing comment really is, if you haven't applied for the COVID-19 deferral and you deferred your VAT last year, it's really important to put that application in now to ensure that you get the maximum period in which you can to repay it over the next 10 to 11 months. So apologies, quite a lot to think about on just a couple of slides. I'm more than happy to pick up any questions you might have at the end. I'm now going to pass you over to Cheryl, who's going to go through some of the key employment tax costs.
Thanks, Martine, and good afternoon all. So today I'm going to be covering the key employment tax costs and allowances that are most likely to impact retailers, as well as covering the advertised areas of the coronavirus job retention scheme, termination payments and apprenticeships. I will also briefly cover new ways of working and off-payroll labour. As we have seen with the easing of lockdown, many employers are now looking to reopen their sites, and there's now a key focus on the uptake of employees either in warehousing or on the shop floor. It is important, therefore, that the areas I'm going to cover are virtually not overlooked in this coming busy time for retailers. Next slide, please. With the coronavirus job retention scheme, as you are no doubt aware, this has been extended to the 30th of September 2021. The scheme, which we all know has many complexities to consider, will continue in its current form until the 30th of June, after which the contributions to the scheme will be tapered as follows. So to 30th of June 2021, the government will continue to contribute the 80% with no contributions by the employer. In July, this will change, that the contribution from the government will reduce to 70% with a 10% contribution by the employer. And in August and September, the contribution from government will reduce further to 60% and the employer contribution will increase to 20%. The salary cap will remain at £2,500. So if you have made the coronavirus job retention scheme claims, it is important that you check whether you're comfortable that past calculations and claims are correct, including any processes that have been followed, and review to understand whether action may be needed to be taken to correct any claims submitted to HMRC. With the so-called furlough fraud reported to be rife, there are estimates of up to 10% of claims that may be wrong or fraudulent. To look to combat this, HMRC have recently announced plans to introduce a new task force to look into incorrect or fraudulent scheme. And at BDO, we are seeing increased activity in this area, with HMRC reviewing claims that have been submitted. BDO's tax dispute resolution team can help you in this regard if you are unfortunate enough to receive a note from HMRC. And in addition, we have further practical support available with tools that we have developed to help you through this process with the scheme, which is called our Process Risk Review tool. Our tool will help clients identify highest risk areas so that remedial action can be taken. Next slide, please. So if we now move on to the second area of focus, being termination payments. An unfortunate consequence of the past year has seen many businesses having to reduce headcount. And termination payments can be a complex area, so it is always key that care is taken in this area. There have been recent legislative changes which need to be taken into account around calculating what is known as the post-employment notice pay, or PNEP for short, as well as the new employer's NRC charge. Further, there are new rules that are coming into force from April 2021, which will also need to be considered to ensure that the income tax and NRC treatment has been correctly applied to these payments. As an overview, the new rules would apply to the use of the alternative PENEP calculations, where an employee's pay period is defined in months, but their contractual notice period, or PNEP, is not a whole number of months, as well as non-UK resident individuals will now become chargeable to income tax and NRC on the PNEP to the extent that they would have worked in the UK during the notice period. These rules are complex and can give unexpected results. You need to understand the rules as well as having a robust process in place to determine that the income tax and NRC treatment is correct, as this will help your business to manage the costs associated with terminating employment. Care should also be taken to ensure that correct legal and tax advice is always sought, particularly where there are well-being issues or at the root of the termination, or notices not being worked and or perhaps overlaps with periods of furlough. Next slide, please. We now move on to the apprenticeships. With the recent announcement from government to support Kickstart and apprenticeship schemes, additional funding will now be available for traineeships for employers in England. The additional funding will cover up to £1,000 per English work placement for apprentices between the ages of 16 to 24, and this is during the 2021-22 tax year. And in addition, there'll be £3,000 available per new apprentice who will be hired in the period 1st of April to 1st of September 2021, regardless of age. From July 2021, new portable apprenticeships will be available. And this will see apprenticeships being expanded as a flexi job to allow apprenticeships to be portable across multiple employers and projects. The apprenticeship framework is now widely drawn and encompasses many apprenticeships that were perhaps not previously seen to be appropriate for the retail sector. This is certainly not the case anymore. And retail apprenticeships are now available to all levels of employees, be that from buyers, managers, or those working in logistics, or perhaps those now working on digital platforms. The range of apprenticeships available will sit well with how businesses have had to adapt when moving to a greater online presence. So we would encourage employers to take advantage of the funding available and to look to access funds sitting in their levy accounts. And as a reminder, any unspent funds not accessed within a 24-month period will no longer be available for apprenticeship schemes. Also, employers' NIC is not payable on apprenticeships under the age of 25, and that's for individuals of earnings up to £967 per week, and that's based on the upper earnings limit for 2021-2022. In this regard, a BDO recently worked with a client, and just during a normal business conversation, the question was asked around apprenticeships, and it was then discussed and realised that employers' NIC was being paid on the apprenticeships under the age of 25, and as a consequence, we were able to work with them and to save them around £300,000 worth of employers' NIC that was overpaid. So a really good result. Next slide, please. So moving on to non-payroll labour and Hour 35. So while this might not be as significant for those in the retail sector, as you're no doubt aware, it has been confirmed that the postponed changes to Hour 35 will be implemented from 6th of April 2021. The rules fundamentally change how workers are paid off payroll and providing services via a personal service company or PSC are treated. While some businesses will be considering how to reduce staff numbers, businesses fortunate enough to be flourishing may well be looking to increase use of agency or contract workers. There is a substantial amount of work that needs to be done to ensure readiness from the 6th of April 2021, when the obligation to assess and determine the status for a worker will move from the PSC to the end engager or fee payer. Any failure to treat workers correctly could lead to unexpected PAYE and NRC costs for an employer. It is therefore key that prompt action is taken and internal processes are reviewed and updated to demonstrate reasonable care has been taken before these new rules are implemented on the 6th of April. BDO have developed 2 tools which can help you through this process. The first is our off-payroll risk manager, which works off your purchase ledger entries and easily identifies contractors for individual review. The second is our off-payroll tracker, which provides you with a clear audit trail to demonstrate you have taken reasonable care of your responsibilities as engager or end user. Next slide, please. For this final section, I'm going to talk through how employers may be considering new ways of working for employees. After the challenges we have all seen over the last year, many businesses are looking to change their business model to a greater online presence, which has meant a reduced high street presence. Further, with many employees now working from home being the new normal, we are seeing many businesses assessing how to move forward towards an alternative way of working for employees, and how to incentivize employees. As a consequence, we are seeing many employees considering ways to implement positive changes to working policies and whether remuneration packages can be structured more effectively to embrace changes to working patterns for employees. Perhaps one of the most important areas of focuses for businesses is employee well-being and the measures that have been taken to support and protect staff, physical and mental health during the pandemic. Commonly, we are seeing things like mental health training, employee assistance program, and online classes such as meditation, yoga, personal training, and nutrition being introduced, as well as plans where practical for COVID testing and vaccination programs. During COVID-19, we have seen HMRC issue some temporary disregards and relaxations of certain exemptions, which may mean that some benefits that previously would have been fully taxable may now not be taxable for the 2021-22 tax year. All benefits, as we know, have employment tax consequences and therefore should not be overlooked when focusing on compliance reporting. Thank you for your time today. I'll now hand back to Neil.
Thank you, Cheryl, and thank you to all our speakers there. So lots of food for thought. Katie, some useful pointers on what kind of spend might qualify for R&D, where you might look, and some pointers as to how valuable that might be so you can assess the cost benefit. Hopefully Martine has encouraged you to step back from your day-to-day workload and review your systems and processes, and definitely some good practical ideas there on both hard cash savings and how to optimize your cash flow. And Cheryl, some useful pointers there to help you navigate through the ongoing complexity that arrives with furlough support. But also some good news around funding for apprenticeships, and some good practical ideas as well as to where you might find some significant employers' NIC savings. So thank you all for your contributions. If we now move to Q&A, if you have got any questions, feel free to post those on the Q&A link at the bottom of your screen. I'll kick things off with the first question for Katie. So on the R&D side, in your experience, how much time is required on the company's side to pull together a claim?
Yeah, it's a good question, isn't it? Because I know everyone's teams are really busy at the moment. So we try and minimise the amount of time that's taken for the operations team in terms of taking them away from the business. But effectively, normally we're looking for an hour or an hour and a half of their time just to explain to us what they're doing and how it meets that definition of R&D. And then we go behind the scenes and do all the writing up and the documentation that you need to support an R&D claim, and then just check in and make sure our understanding is correct. And finance teams can outsource an awful lot of that work and heavy lifting to us as well. But the difficult part with R&D claims is often finding the right people within the business to speak to. And for that, we really need that business partner role, that kind of person within the business to help us with that. but thereafter a lot of the work can be done by the BDO R&D team, so we can let you get on with running your business and help you to identify that cash.
Perfect. And a lot of our clients are international businesses, and there's a few on the call today. So we've focused here on UK R&D relief. Is there an opportunity to make claims in other jurisdictions as well?
Yeah, you're right. We have. I've spoken just on our UK R&D. You only gave me 10-15 minutes, Neil, didn't you? But there are similar schemes internationally. So you would see similar things in France, Germany, US, Canada, many key locations. I guess what's important for the people on this call is to understand where the investment is made in their business, and of course, so where those key functions are, which could go hand in hand with things like your transfer pricing. So hopefully you can see where key parts of the business are driving value, and then look at those relevant schemes. So it might not be the UK one, it might be that all of the development work's driven from the US, and so it makes sense to look at those R&D reliefs wherever they match what's going on within the business effectively. And you can even combine those, so make claims between the UK and US on similar types of things. So if you're an international business, definitely look at this from an international perspective too.
Beautiful. All right, thank you for that. And Martine, you talked a bit about daily gross takings. So in the new sort of digital world, if I identify as a retailer that I could have made an adjustment to sort of depress the gross takings number, how do I go about taking advantage of that? And do I need to let the revenue know?
Yeah, so if you identify anything that you've overpaid output tax on, or you haven't claimed enough on the input tax side, typically you go back 4 years and you can write to HMRC and make a claim. So definitely worth having a look at what you've got in place with regard to some of those DGT adjustments. And if you're not taking the benefit of all of them, then yeah, definitely worth going back and popping a claim into HMRC for that period.
Okay. And you gave that example about the property costs and alternative evidence. How easy is it to go through something like that, to approach the revenue with a different take on something, and what do you need to do?
So I would say that it really depends upon the level of the alternative evidence that you have, and your key processes and controls that you have in place. Getting HMRC comfortable around this is really getting them happy and satisfied that we're not going to take a double deduction on anything. Alternative evidence is concession, so you have no right to it, but HMRC have a right to agree that you can use alternative evidence for VAT recovery purposes. So as I say, I've seen it, I've done it. HMRC do agree to it, but a lot of it comes down to making sure that you've got a good story and that you do have a really good process in place to ensure that double deduction doesn't happen.
Yeah, so you have to put your best persuasion hat on then to
yeah, absolutely. Sometimes it comes down to the officer, so and whether they're comfortable or not. So it's really setting out the story well, and making sure that what you're saying is reflective in actually what's happening within the business in respect to some of those process control points.
And Cheryl, last question for you. So there's been a lot of press coverage recently about Uber and the status of their drivers. Do you see any implications of that case for the retail sector?
I think the first thing just to note there is that obviously that was an employment law case, so we can't comment on the specifics of the case. However, what it has meant is that the Uber case has led to drivers now being treated as workers. And while this is probably not something that would directly map across to tax, which recognises employees or the self-employed, they are now guaranteed to be paid national minimum wage. And they have been also agreed that they'll be provided with some benefits. And this will obviously have considerations relating to employment status, where we're looking at the tax position. we've also seen recent hearings in the general gig economy on workers, which has involved Deliveroo, and obviously Pimlico Plumbers was also one that was in the press. So it's becoming more and more clear that employment status is very much something the government has at the front of their thinking, and obviously that follows on from the Matthew Taylor report on employment status, and then of course would lead back into IR35 reforms. Thinking about it, I mean, ultimately the direction of where this is going to is that there's going to be more and more obligations being placed on employers to monitor and ensure how they are looking to engage in workers, and to make sure that they get the status right, and more importantly, their tax and NIC treatment correct.
Yeah, definitely true. And I think I read this morning that Deliveroo's target listing price has been reduced by 6 or 7% because of this.
Because of this, absolutely. People are a little bit wary of where this is going to lead. So yeah, absolutely.
Very good. Okay. So no other open questions at the moment. So thank you all for your contribution and your presentations, and thank you all for listening. And we hope you can join us again soon. Cheerio.